please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's invite our market master for the day, Tushar Pradhan, CIO, HSBC Global Asset Management Company is with us. Tushar, good morning. Your thoughts on the recent market capitulation, especially in broader market? You think there's more to go, or has that presented a good buying opportunity?
Yeah, I think if you look at the reason why the market seems to have capitulated is the fear that this trade war that is erupting is going to encompass, the entire globe, and there is going to be pretty much a lot of pain for most manufacturers. Typically, trade wars also lead to inflation, and I think that was the other worry. And if you have trade barriers coming up, then oil also becomes a little bit of an issue with the Iran thing and how the price of oil actually settles. So I think that is the principal reason why there was weakness all over. That also led to a pretty strong dollar. And in the event of a strong dollar, the vulnerability of most of the emerging markets comes to fore. There is a lot of worry about whether there will be a capitulation by the foreign investors in emerging markets per se. But I think as the events have rolled over in the last few days, it appears as if the actual impact of the trade war may not be as high as most people calculate. And I think there will be some tempering of these kind of extreme reactions as well. I think what is most important for investors in India to focus on is the earnings recovery, which is pretty visible in the last 3 quarters. And I think as the rhetoric or the news start to get worse, I think the situation actually starts to look more attractive because in the past few, I would say, periods of trading, or say even a couple of years, the rhetoric has been pretty positive, but the earnings have not been delivered. So it resulted in this valuation expansion. But I think going forward, you will see maybe if the rhetoric starts to get worse, but the fundamentals turn around, I think that's a much safer environment to invest.
Okay, good morning, Tushar. Good to have you with us this morning. Much of the market increase, market rise has been helped by the small investor, by the SIP culture. How has it been in June? Yesterday we had one of the fund managers telling us that while there has been no redemption, the incremental inflows in June were not as good as May. What's your experience?
Well, I think I don't have the numbers myself, but I think typically what tends to happen is when the SIP is sold or someone gets into a contractual agreement to say, let's put some money away in equities, he's largely coming in with the expectation of a rising market. And I don't think much of everything else on the longer term is something which is very evident at the start at least. So I think there is very naturally a reaction to say, if it is not going up or if it is coming down for some time, then let me stop the SIP for a while. But having said that, we may have crossed over a period of maturity where we've seen increased interest in SIPs over the last few years, in fact. So I think the people who have been in the SIP program for over 2 or 3 years are not the ones who are going to capitulate. I think it's the newer ones, and rightly so, as you mentioned, the rate of new additions to the SIPs may actually see a temperance because they may not see, some sort of upside there. And with the interest rates going up the way they are, I think the alternative opportunity also might look a little bit more attractive because of the risk involved on the equity side as opposed to the fixed income side of the picture. So I think there is always going to be some give and take between asset allocations. But I don't think there is any alarm for the overall SIP book because I think that has reached a fairly critical level. And as I mentioned, this SIP generation has been not something recent. It has been building over the last 2 years or so. And I think those SIP flows are fairly secure. But as you know, the retail investor is always prey to news, and it is always going to be some reaction on the basis of some weakness in the markets, at least in the interim.
Okay. Tushar, good morning. So what phase of the market do you think we are in right now? Do you think this is the start of a bear market, or is this still the mature phase of the bull market?
Well, I would argue that from a fundamental perspective, the bull market has not started yet. If you look at how prices actually follow, they follow earnings. And in the last 2 years, earnings have not been delivered. Actually, the market has gone up in expectation of earnings growth, and I think which has been delivered fairly in the developed markets, especially in the US. So earnings growth has been extremely strong in the other markets. Liquidity has been high, and all of that has led to our markets also going up, but they have gone up without any corresponding increase in earnings. As we go in the next few quarters, I think we're going to see a significant increase in earnings. And if, unfortunately, the environment changes to kind of, not give the earnings the kind of due that lack of earnings in the past few years have got, then you will actually see a return to the mean in terms of valuations. And in that case, I don't think there is any reason for us to believe that there will be a bear market. At best, there will be some sort of, I would say, consolidation, so that it will consolidate at a time where earnings are rising and expectations of earnings rises in the future may not be that high. But as the earnings keep piling up, and we are hopeful that FY19 as well as FY20 is going to be very strong for earnings growth for the entire economy, I think that will be a time when people will actually have seen the elections behind them. They will have the environment a lot more clearer than what we are here. And I think that will be the second leg. But it is very difficult to predict the markets at all at any point of time. But I think if the earnings keep coming up, then clearly I don't think a bear market is in store for us.
Bear market, but Tushar, it was because of the expectation of these earnings that we saw this mammoth 2017 rally. Small cap index up 60%, mid cap index up 40%. Now we are seeing the give back period. You don't think the give back will continue irrespective of the earnings growth? Are there still bubbles and are there still excesses in the mid-cap space and therefore more selling?
Yeah, I think it's an interesting point you make, Lata, but I think let me give you some facts and figures. The earnings growth for FY17 for the mid-cap index alone was close to 60%. Can you imagine this kind of growth? So the price rise that you're seeing in the following year is actually in anticipation of this kind of momentum of earnings continuing, which obviously is not going to happen. But it's not as if the 60% rise is out of nowhere. It is supported by a very significant earnings growth in the underlying companies. And the problem is that when we look at the market, we look at only the narrower index, the Nifty and the Sensex, where the earnings delivery has been much poorer. But in the mid caps and the small caps, the earnings growth has been extremely strong. The question mark, of course, and I think there is validity in your point to say that, is this kind of momentum going to continue? Clearly not. But is earnings going to come down and go into losses? Not really. So I think it is more or less a tempering of the multiple rather than just the price that we see in the market going up 60%. The multiple of the mid-cap index is something that we have to watch carefully. And I think on the expected numbers that I can remember, it's about 19 times 1 year forward. And I think that is compared to the Nifty, which will be between 17 and 18 times. So I think they're really, which will be between 17 and 18 times. So I think they're really not off the wall. And if the earnings growth continues to remain between 15 to 20% for the next 2 years, then I think given the fact on an average we are slightly maybe 1 or 2 multiples higher, it doesn't seem as if it's extremely expensive for us to expect a sharp downturn. And that's the point I'm making. So at best it'll consolidate. And if earnings continue to remain buoyant and the environment of business changes in this country and the uncertainty goes away, then I think there is, earnings growth coming, and then the prices will reflect that as well.
Okay, that point is taken. By the way, a couple of stocks surging. IDBI is now up about 9%. That's an exclusive flashing on the screen. We'll just get back to that as well. And also, keep an eye on RCF. Yesterday, there was that news of getting that bonanza of development rights after many years. Of course, the market was weak yesterday, but that stock also seeing quite a bit of buying momentum right now. So that's also interesting. Tushar, this last year was also about the cost of capital rally. We had small cap index rally about 60%, mid cap index rally 48%. Even if mean reversion has to take place, don't you think we could be in for one more round of capitulation in the mid and small caps?
Again, as I said, we don't think we can predict whether it is going to happen or not happen. It may happen, but will it sustain is the question. I mean, if you have a reaction for a day or two or a month or so, I don't think that is a permanent derating in the market. And that's something which I don't think will happen. Will it have a reaction based on some external event or something which is even internal, which suddenly sends a shockwave in the market? It is likely. But if you look at the breadth of the recovery, if you see the kind of earnings growth across industries that we are seeing now, it is very unlikely that this kind of momentum just suddenly stops in between and turns and reverses. So I think the case to be made is, for now, what we are seeing is that earnings growth has been fairly patchy. So you've seen certain sectors which have demonstrated very significant earnings growth, and there are certain sectors which are actually struggling, like the banking sector, for example, as well as some of the companies in the infrastructure space which are really struggling. So what we tend to see is a little bit of a contrast between things which are not doing very well and things which are doing extremely well. So we find it difficult to kind of come to a common conclusion. But as the economy changes and all of the bottoming out of the situations in the public sector banks, for example, start to sort themselves out, I think it is very, very important to focus then on the fact that the entire synchronicity in terms of how the sectoral earnings growth starts to move is something that we have to watch out. So the risk is really not how bad it will get. The risk is that we become complacent, saying that the market may either not go anywhere or it may actually come off, and it might surprise us on the upside. So I think staying invested through the volatility is probably the most important thing at the moment, because we don't see much fundamental reason to get worried. Interest rates are slightly higher, yes, but they are peakish. Inflation, again, as the RBI has said, that it is not really expecting it to shoot up.
Sure.
Liquidity is fairly comfortable. So I think on the whole, it appears that the fears may be high, but I don't think fundamentally there is so much reason to get worried.
Okay, that's good to hear, Tushar. For the last 4 or 5 days, we've heard so many reasons why the mid-caps should fall and tumble and maybe even crash. Good to hear that you don't expect so much. Thank you very much indeed for joining us. You're also joining us on a day when the markets are in a cheerful mood.